Hello, everyone. My name is John Graham. I'm a finance professor at Fuqua, the Fuqua School of Business at Duke University. And today I'm going to talk to you about some issues that chief financial officers and other corporate executives should keep an eye on in 2021. So this is sort of a kick off the year type of talk today. Now, to be clear, I will identify issues that any given company might want to talk through. I'm not going to give you a lot of the answers because the answers vary by company, by the industry they're in, by their circumstances, et cetera. But we'll talk about the issues. And these are things that are on the plate of a lot of CFOs and other corporate executives right now. Okay, so the first thing I'll mention is I've been working on a research project now for a couple of years looking at corporate planning. Okay, this is kind of context. And in fact, many MBA students helped me kick this thing off. I don't know who might be watching today, but recent alums might be aware of this project from having helped me kick it off a couple of years ago. But at any rate, so what we did is we're looking at corporate plans. And one thing I've noticed among many different dimensions to the project, but one thing I've noticed is that companies don't really anticipate the really good scenario that might happen out in the future or the really bad scenario that might happen out in the future. Today, I'll talk about the bad scenario because that's kind of the world we're living in right now, but there are some interesting implications on the upside also. So for example, if I was to go to a company and say, hey, here's a bad scenario for your company and describe some negative events, they might say, you know, that's unlikely to happen. There's only a 5% chance we think that really bad thing will happen. In fact, it turns out that about 20 or 25% of the time, those events do occur, okay? And so in other words, companies get surprised by the downside that actually happens more often than you would think, all right? So that's one of these implications from this study I'm working on about corporate planning. Well, that means companies get surprised a lot, okay? So if you're a company and you don't want to get surprised, but you know you might more often than not, then you have to take precautions, right? And so one of the first messages I'll leave you with here today is be very careful and deliberate about your planning and be very aware of downside possibilities. We don't like thinking about the negative outcomes, but we need to plan for them. For example, one example, some years ago, the oil executives couldn't imagine the price of oil would go below $80 a barrel, $70 a barrel, maybe. Well, it's been at $40 a barrel for like 4 or 5 years now, okay? So a really bad scenario for that industry happened and is still happening, okay? Now, what happened in March, of course, well, that's when the corporate America and the rest of us Americans woke up to the COVID crisis, all right, coronavirus crisis. It was already brewing, but we didn't think it would really be a big deal. You can look in the data. On March 15th was about when the US woke up. I mean, the stock market actually woke up in February, but corporate America probably woke up in March, okay? And so I've been working on a study with some other profs, and we've looked at how are companies managing through the downside crisis that has hit us, okay? Well, one thing companies did, if they were able to, is they went out and borrowed a lot. They borrowed from the bank. They maybe issued some stock. They drew down on their line of credit. They got a lot of cash, okay? And they put that cash in the bank because they wanted a buffer against this downside. So I know I just talked about downside planning, and now I'm telling you this is an action companies took when that kind of surprise negative downside occurred. They were able to do that in this crisis because this has been more of a health crisis than a financial crisis. I mean, it's affected a lot of businesses, but it hasn't really affected the banking sector or the stock market as much as you might have thought. So companies have been able to still access funds, at least many companies have. They stockpiled the cash. Okay, now we're rounding into 2021. There's some vaccines rolling out. Things might start getting better. We sure hope pretty soon, okay? How long should they hold on to this big pile of cash? So a second issue companies should think through in 2021 is how much is too much cash, okay? If you've been fortunate. I mean, think about it from our own perspectives. We might want a little extra in our checking account right now just to handle some bumps in the road that might come about because of the economy that we're in the world around us right now. But do you really want to put all your retirement savings in your checking account until you retire? No, you don't. at some point you need to start investing for the long term. Companies need to carefully evaluate that issue going into this year. All right. A third issue that companies should consider is a remote workforce. Now, we all know this. Many of us are living this. I'm sitting right now in an office in my basement talking to you. I'm working from home, okay? I saw a recent statistic that 25%, so 1 out of every 4 articles written in the business press in the last few months about the corporate side of business has been about work from home, okay? It's a big deal. Everybody knows about it. But we've been able to also do some research on this, okay? So because we were doing a big survey of companies from February through April, right when the crisis was hitting, we got to kind of observe how companies reacted. And we've done additional surveys of companies in June, September, and December. How are things going now? And here's what I can tell you about how companies are managing. Well, the key dimension really, more so than the financial side that we might have seen in other crises, has really been this work from home component, all right? So of course, work from home has allowed some companies to maintain a full workforce or close to it and produce their product or close to it, okay? So that's not too surprising on the employment side, whereas an industry where you can't work from home, that's where the layoffs have been. So I'm not telling you anything you don't know right now. But what's a little more interesting is the work from home component has had a very interesting effect also on corporate investment. So the investment side also, okay? We typically think, oh, we're in a big recession. Companies are going to cut investment to the bone or something like that. That's not really what's happened, at least not across the board this time. So here's what's happened. Those companies that do have good work from home capabilities, some of those companies have actually increased investment, okay? You can think of companies spending on new servers or new software or other things to facilitate productivity from work from home. So for some companies, if their investment spending is flexible, they've been able to spend more, or not only been able to, but that's the right thing for them to do. For the other companies that work from home is not flexible, well, these companies have actually cut investment when they can. So if they have the flexibility to cut it, they've cut that investment. So you have different effects on corporate investment dictated by whether the company has this work from home feature, okay? So there's sort of like a double winner of work from home and a double loser if you are not in a work from home industry, okay? There are other companies that it's not as tied from work from home because they just have to keep investing. They're building a bridge or something, and you don't just stop that and come back 4 months later. Usually you just keep working on it. But for many companies, there's been this up and down increase or decrease investment aspect, okay? All right, I'll come back to a little bit more to that in a few minutes. Or actually, let me just say it now. There is one other really interesting component about this work from home. Remember, we talked about companies that can't work from home right now. Those companies, there is one type of investment those companies are doing, automation. So there has been an acceleration towards automating to reduce the need for labor, okay? So one thing this crisis has brought on us is it really accelerated some trends that were already out there. There already was a trend towards automation, but now some companies realize we simply cannot do business if it involves a human being there in that situation at that moment in time. The desire to automate has increased for some of those companies. So even though companies who are struggling in the work from home aspect could be investing to automate, okay? So that's an interesting long-term implication to consider. All right, fourth issue is taxes, all right? So we have corporate taxes right now. We have a new president, or nearly do. We have a new president-elect. It looks like we'll have a pretty evenly divided Senate, okay? So one thing that President-elect Joe Biden ran on was increasing the corporate income tax rate from the current 21% up to 28%. So an increase of about 1/3. Pretty big number if you're at the corporation and you're worried about how much taxes you're paying. Now, look, of course, the reason that the government likes to raise taxes is to get revenue to do good things with the revenue. So I'm not denying that could happen. I'm just looking at it from the corporation's perspective today. Your taxes are probably going to go up, okay? Not only that, if you do business outside of the United States, President Biden-elect has proposed a minimum tax on foreign profits, which there have been a lot of changes to the foreign tax rules from the US perspective in recent years, but he's talking about basically increasing taxes on foreign income also. And on top of that, they're talking about increasing the capital gains tax rate that investors pay. Like when a stock we own goes up and there's a capital gain, if we cash that in, we have to pay a capital gains tax. That tax rate might go up, which could have the effect of increasing the cost of capital for companies. So there are some very important tax implications to a new administration. Definitely a big issue that companies can and should be paying attention to. All right, that was 4. Number 5 is interest rates. We are in a very low interest rate environment right now. We know that too, right? But these are kind of record low interest rates. The Fed has promised that they will keep interest rates low for at least a couple more years until employment's fully recovered and inflation is much higher than it is now, et cetera. So we're looking probably at a low interest rate world for at least another 2 or 3 years, maybe longer. We've been having low interest rates for quite some time already. So what are some implications here? Well, here's an interesting wrinkle. One wrinkle is right now the average dividend yield for companies that are in the S&P 500, so sort of the largest 500 companies, the average dividend yield is 2%, okay? Meaning approximately half of companies have a higher than 2% dividend yield. Well, dividend yield is the dividend you pay over your stock price. So if you pay a $2 dividend and your stock price is $100, that would be a 2% dividend yield. Well, half companies are higher than that. Let's just say there's some companies at 3 or 4% dividend yield. Some of these same companies right now have a very low cost of debt. Remember how we said interest rates are very low? So if your cost of borrowing is low and your dividend yield is higher than that, and don't forget, when you borrow with debt, you can deduct the interest. So that even reduces the effective or after-tax cost of borrowing even more. Some companies are in a position where they can borrow cheap, repurchase shares, and extinguish the dividend. So they can actually, by borrowing and repurchasing shares, improve their cash flow situation. That's unusual. Usually when you borrow and you have a commitment to pay that interest rate, that's tying up your cash flows. But what I'm describing here is if your cost of borrowing, after-tax cost of borrowing is lower than your dividend yield, you can borrow money, repurchase shares, and actually improve your net cash flow because you no longer have to make that dividend payment, okay? And so I would expect to see some companies at least seriously consider doing that. Even if it's not quite like I laid out where your cost of borrowing is less than your dividend yield, it's a lot closer now than it usually is. And so at the margin, we would expect some companies to take this action, all right? Well, what are other things that you might that might be affected because of very low interest rates? The world we live in now, cost of borrowing is low. I just mentioned that. We think capital structure could change. Companies might lean more heavily towards using debt because it's easier to pay the debt down, pay those interest payments when it's at a really low rate, just like a lot of people are buying houses now or even buying big houses now because they can afford the mortgage payment because interest rates are low. Same thing applies in the corporate sector, okay? Here's another issue that I've been looking at for a decade, at least a decade now, if not longer, is the hurdle rate that companies set for investment decisions. Now, what do I mean by a hurdle rate? The hurdle rate is a company comes in and they say, we will not invest in a new project if it doesn't beat this hurdle rate of, let's say, 14%. So a new investment has to earn at least 14, 15, 16 or higher % before the company will do the project, okay? Well, when interest rates come down, so the cost of funds to the company in order to do the project, when the cost of funding falls, you would expect the hurdle rate to fall because now I can borrow more cheaply. I should be able to do more projects because the cost I have to pay to borrow is less. But what's happened, you can go back to the 1980s and look at it, the hurdle rate has stayed very constant, very sticky for decades now, right? Quite honestly, it doesn't make a lot of economic sense. But what's happening is companies are keeping that hurdle rate high even when the borrowing cost falls. What that means is there's some investment projects that, let's say, earn 13%. That might be a pretty attractive investment that are getting passed up because companies keep this really stubborn hurdle rate too high. So another issue for companies to consider right now in the world we live in is, should they adjust their hurdle rate? Okay, I hope some of them consider it. Past evidence is not many will, but I hope they would consider doing that so they can properly evaluate investment projects. All right, let's see. I've got two more things I'll talk about here. One is ESG. Okay, companies right now, there's a lot of pressure to do right by their customers, employees, the environment. All right, and in the past, we've said companies, they maximize shareholder value. That's the primary thing they do. All right. Well, now there's a lot of pressure to do other things right too, with the environment, your employees, customers, your community, et cetera. Now, the debate goes that you could argue that, well, if you're doing right by your customers and you're doing right by your employees, you are simultaneously maximizing shareholder value. And I do think that argument is a pretty good one. Having said that, there is a lot more pressure now where some investors are saying, we're not going to invest in your stock. Like some big investors like money manager BlackRock, we will not buy into this company's stock unless they do a much better job on ESG. So this is something companies have to take seriously now and evaluate. And finally, another issue for companies to consider at this point is supply chain, right? So we saw that companies that had one foreign source for supplies of key inputs, and if something happened that got messed up with tariffs or the political situation or transportation during the coronavirus, they couldn't get the input they needed. So companies need to reevaluate now, should they diversify on their supply chain, okay? I would argue the answer is yes, but like most other things in life, it's going to cost them to do it. If you're going to go to the second cheapest supplier and the third cheapest supplier just to diversify, you'll be paying more. And companies need to evaluate that carefully so as not to get burned where they have all their eggs in one basket with one supplier, but at least to consider more broadly. Okay, those are my prepared comments, and there are other things companies should pay attention to now too. But I'm going to turn now to some questions. All right. So one question, yeah. So by the way, please do enter. Let me just say a couple perfunctory things now. Please enter any questions you have in. I don't know if it's the Q&A or chat box. It's probably the Q&A. And we'll manage to pop those up on screen so I can read those and deal with them. I also want to let you know that next week, Professor David Ridley will be doing this LinkedIn Live, and Dave will be talking about new research that shows how Medicare policies drive up drug prices. So you want to tune in again next week. So one issue I talked about briefly earlier was automation, okay? This is a trend that has been ongoing for some time. And I've got a question here. What types of employees are being replaced with automation, all right? And so we can look, again, but by doing these CFO surveys, we've got some great data on this. And I can look and see that the companies, as I mentioned, that don't have the work from home capability are the ones who are automating now. What type of employees are they replacing? Primarily, it's workers on the low skill end of things, okay? So again, unfortunately, this is a double or a triple or a quadruple whammy on kind of the lower skill, lower wage scale employees who are getting hammered by this. They are the ones more likely to also be replaced by automation, by a robot, for example. Now, having said that, white collar employees are not immune, okay? What we're starting to see more of is AI, artificial intelligence, and machine learning and such that's able to do tasks now that we think of as a higher skill level. And so among the firms that have these employees that can work from home, it so happens there's a correlation here where those companies are actually doing some automation to even replace kind of white collar workers, if you will. And so that's something to keep an eye on. It's affecting broadly across employees across the economy. Another thing I talked about earlier was this corporate planning. And I mentioned that companies don't always do a great job on the downside planning, and likewise, maybe not on the upside planning. So let me just give you a little data on that. Somebody asked, can I give an example of how this works, or why aren't companies anticipating, we call them the tails of the distribution, the really good and the really bad outcomes that may occur, okay? Well, this is actually a common human element, where if you ask someone, how far away is the moon from the Earth? How many miles do you think it is? And you ask them to give an answer, and then you ask them to say, what's the probability you think your answer is correct? People assign too high of a probability that what they're saying is correct. And that's basically what happens with executives also, okay? So we've done this long study with Professor Cam Harvey, and I've been working on this really for quite a long time, where we've looked at how well, we call it calibrated, CFOs are. And this is where it turns out they don't anticipate the good and bad scenarios. And here's one little summary number for you. When we ask them to forecast the stock market, I know that's a little bit out of the corporate world, and to give a distribution, like what they probably, basically, when they say we think there's an 80% chance stock prices will end up in this range, it only actually happens 30% of the time, right? So they are severely off on assessing the distributions. This is not to pick on CFOs, because it seems to be a trait that holds for all human beings. All right, let me take a question here from Pat Schultz, who's an alum. Let's see. All right, I made a comment about stock buybacks, that this could be a time with very low interest rates for companies to borrow in order to buy back shares. And the question is, are analysts looking at leverage differently today and more favorably given the low rate environment? So the answer is partially, okay? There is still a stigma about having too much debt. And I didn't mean to encourage companies to lever up like mad just because we're in low interest rates. But the ability to cover that interest payment has greatly improved. And so when you think about interest coverage ratios, which is one of the key elements in rating agencies when they rate a company's debt, or for analysts when they evaluate a company, the interest coverage ratios improve when you have a low interest rate. There's more cash flow to cover that smaller interest rate. So yes, there is some improvement in the view of analysts or rating agencies on leverage because the interest coverage ratio has improved. Again, there still is somewhat of a stigma of having too much debt, so you don't want to push it too far. I should say one more thing here, and then I'll wrap up shortly. That list of, I should have said this at the beginning, apologize for forgetting. I made up that list of things I talked about for 2021 with a colleague, Mark Zenner, who was a professor at our rival school down the road there at one time, and then he ran corporate finance practice for JP Morgan for a long time. So I want to give Mark some credit for that work today. All right, folks, you know where to find me. I get emails from alums and such all the time. So I'll go ahead and wrap it up here. It's been good talking with you, and I hope you have a fantastic 2021. Thank you.